Hello and welcome to the special edition where we are covering earnings from Tata Consultancy Services, and prima facie the way things are panning out, it's looking like a beat not only on the top line but also on the bottom line. Let me just take you through the numbers. So far we just have numbers in rupee terms. So when it comes to the top line, we're looking at a growth of around 6.8% at little over 3,400 and 261 crores. And this is certainly a beat when it comes to the Bloomberg estimates, which stand at 33,927. So it's a beat on the top line. When it comes to margins, again standing at around 25% against 25.4% sequentially, though do remember our estimates were below the 25% mark. So it's a beat on an operational level as well. Consequently, we have seen profits rise 6% sequentially at 7,340 crores against 6,925 crores. So I take that investors are going to be happy with the earnings at this point in time, considering they have beaten street expectations. In terms of your verticals as well, we are looking at substantial increase when it comes to the banking and financial services sector, and the vertical, this vertical especially, which has seen a lot of challenges over the previous, well, I would say more than 5-6 odd quarters. We've seen a substantial growth come in at around 8.3% sequentially. This is a significant boost, largely on account of the large deals that TCS has also signed. But let's get in a voice. We have Urmil Shah, research analyst at IDBI Capital, joining us. Urmil, hi, thanks for joining us. Tell me, what do you make of the initial numbers? What's your take? From Bloomberg consensus point of view, it looks like a beat. Is it a beat according to your estimates as well?
Yeah, hi. Yes, the results are a beat to our forecast. In fact, across the board, we were building in a 3.2% growth in CC terms. A 4.1% growth is extremely good, considering that Q4 was also very strong. So this places TCS in a very strong footing, in line with our expectation. As we have been telling that we expect TCS to deliver the best improvement in revenue growth in FY19 amongst the large caps.
Okay, Urmil, you know what really stands out for me, and I don't know if you've had time to look at the verticals, but from the income statement, I'm looking at an uptick of around 8.3% in the BFSI vertical. This, of course, includes insurance as well, and also this is in rupee terms. This is a little bit surprising, perhaps the reason why we have seen this boost come through as well. What would your reading be, and is this as per your expectations, or is this better than your expectations?
So, I would say this is better than our expectation. I'm just looking at the press release. It is talking about BFSI growing at 3.7% on QOQ. Maybe that's the USD number. Even that is very strong, because we were expecting that insurance would grow well, but looks like BFS has also been at least stable.
Right, Urmil. So I'm assuming that this growth in the BFS vertical is coming essentially on the large deals that the company has signed over the previous 2 or 3 quarters. Can you name us some of those deals that you think that likely could have pushed these numbers ahead, especially in the banking and financial space? What's going on really, and what is it that's lending strength to the earnings, especially in its largest vertical?
I would say among the large deals, what they have announced, it was a Trans-America deal, which was really big, and part of the insurance vertical. And they followed it up, with, it is more than $1 billion deal broken down into 2. So clearly, that is the deal which I think would have ramped up because it was announced, if I'm not wrong, towards the end of 2017, and so definitely there would have been a ramp up in the same.
All right, Urmil, I'm just going to take maybe a few seconds to recount the way verticals are panned out. So you can also take a look at the numbers. But in the meantime, let me just address. We've also seen manufacturing that has seen a growth of around 4.8%. Retail and consumer business is looking at an uptick of around 6.1%. And this is the second largest vertical for TCS if you consider the banking financial services along with the insurance vertical. If you club them together, then retail is the second largest vertical. Coming next is communications, media and technologies, and this again is a surprise because what we've seen over the previous few quarters is some amount of volatility in both retail as well as communications, and we've seen about a 5.1% uptake in communications and media as well. In terms of margins and the way these margins are panning out for verticals as well, we really haven't seen a substantial improvement in the BFSI segment, but I reckon that what will stand out will be the growth for this particular segment. That said, Urmil, if I can come to you on the possible volatility in retail and consumer business over the previous few quarters, and the same for communications and media and tech. The management has always suggested that it's bottomed out, and eventually we're going to see a turnaround. And this time around, the numbers seem much better than what we were working with. Do you think that this is the quarter in which, we've possibly seen, them turn a corner, and perhaps from here on there could be some more improvement going ahead?
Agam, in fact, we felt that in Q3 of FY18 is when they had turned the quarter, and they followed up with a good Q4 FY18. And, that's why we felt that it is well placed to deliver a double-digit growth at, the size at which TCS is. And yes, the Q4 outperformance only reiterates that clearly TCS is well placed to deliver a double-digit growth in this year.
Right then, Urmil, what are you looking out for when it comes to management commentary? What would you like to hear from them?
So we would want to get a sense of how BFS within BFSI has worked out. Also, digital revenue has grown by almost 45% on a YY basis. Would want to understand, as to how much of that is because of the ramp up of the deals which it had secured towards the second half of FY18, and also, a commentary on, how client budgets have closed for the calendar year as a whole.
Okay, just hold that thought, Urmil. I'm going to recount a few more pointers here that the press release is mentioning to us. North America growth seen in the highest in 12 quarters. And again, as I was mentioning earlier in the morning as well, we did see Accenture indicate this growth in North American business, especially in the previous quarter when that growth for Accenture had not percolated for something like a TCS Infosys. This time around, it's showing that uptick for TCS at least. It remains to be seen whether or not Infosys can also come through. Now, again, when it comes to its operating margins, that stands at around 25%. We were expecting a little bit of a hit when it comes to wages. It seems that on the other hand, the tailwinds provided by the currency to a certain extent possibly have curtailed this big hit of wages coming through in this first quarter. And of course, at this point in time, the press release also mentions that the net cash from operations is at around nearly 104% or net profit, and thereby also possibly giving you an idea about your net cash flows. That said, in terms of digital revenues, that stands at around 25%, and it has jumped 45% year on year for this quarter. This is a very big and important aspect for all the IT companies, and well, again, as for TCS as well, they've come through. Urmil, considering the way margins have panned out again, we were working with the tailwinds coming through from the currency bit, but we really weren't expecting such a big, impact, and of course there's this wage hike. So what is it? Is it that the wage hikes impact is less, or is that big up move and lift that's been coming in from the rupee depreciation against the dollar, at least prima facie at this point in time, about what your thoughts are?
Sogam, I think it's a combination of a beat on the revenue growth front, as well as the INR benefit. And clearly, if you see TCS's track record, they have been the best amongst the large caps as regards margin management. I think growth coming in has what really has also resulted in the margin beat coming in.
All right, Urmil, and do you reckon that they can maintain these margins going forward? I know that the management has been talking about 26 to 28% band for the longest time, but do you think they can hold on to 25% at this point in time?
Agam, in fact, I believe that if rupee remains at depreciated level between 67 to 68 for the rest of the 3 quarters, in fact, they can definitely improve from Q1 levels because rest of the 3 quarters wouldn't have the headwinds from current salary hike. So clearly, margins should improve from here for the rest of the year.
Fair enough. Just a couple more questions, Urmil. Can you tell me a little more about what you're looking out for in the digital revenue space?
As I said earlier, we would want to understand as to of the 45% growth which has come in, how much have the deals which in the second half of FY18 which they secured, ramp up of that has contributed. Secondly, TCS has been maintaining that the scope of the digital deals, and thus the engagement as regards time, as tenure of the deal, as well as the deal size has been going up. So would want to understand a commentary on that as well. And also, one of the area which can result in BFS really picking up would be the pickup in digital spend in BFS, specifically for TCS's large clients. So a vertical commentary on BFS as well, specific to digital, is what we would look.
Okay, just hold that thought, Urmil. I'm going to read out Gopinathan's statement in the press release as well, which is very interesting and builds on its plan of Business 4.0. It's been mentioned in its annual report as well. And, they do suggest that, okay, there you have it. It's on a screen. Our banking vertical has recovered very nicely this quarter, and while other industry verticals maintain their momentum with a good set of wins during the quarter gone by, the robust deal pipeline and accelerating digit demand, we are positioned well for the future, and that, well, so to speak, defines the quarter gone by, because it is the recovery in that crucial and its largest vertical, the banking and financial space, is what is driving earnings this time around. A substantial increase on a quarterly sequential basis when it comes to BFS. I want to add a few more comments from Gopinathan as well. In the press release, he says that customers across verticals and markets are embracing our Business 4.0 thought leadership framework and are accelerating the demand transformation journey. Our contextual knowledge, full spectrum capabilities, and investments in research and innovation are making us, well, the preferred partners for their growth and transformative initiatives. Urmil, before I let you go, what would your stance be on TCS at this point in time? What is your rating, and what kind of price targets are you looking at? Is it likely to change going in?
Yes, Agam, our forecast is likely to change because right now our forecast for FY19 is based on exchange rate of 65.5. That definitely should increase by 4 to 5%, and also given that Q1 is a beat, so I believe that our earnings for TCS itself would go up by 6% plus. So to that extent, it would affect our target price as well. So we have an accumulate rating right now. I think we would maintain that.
Okay, an accumulated rating out there as well. Do remember that there is also the question of the TCS buyback, where we will get more details when it comes to its timelines as well. At this point in time, I'm just looking at its assets, and the way we're looking at the balance sheet pan out. Well, there's no doubt about the fact that TCS has one of the strongest balance sheets on the street right now. But that said, Urmil, what do you expect when it comes to a stock reaction, keeping the buyback in mind, which is set at around 2,100 rupees per share?
So, Agam, I think the stock has already reacted to the buyback news, so that is in the price. I would say that, at this size, delivering 4%, 4.1% CC growth is a nice surprise. I think the stock should react positively to that in the near term, unless and until, we hear something negative on the call.
Okay, we also have Sajid Mangat or Bloomberg joining us. Hi Sajid, it looks like a very good quarter for TCS considering it has beaten street expectations on all fronts, and that is including the top line, which is very crucial. But more importantly, we are seeing that growth come in from the banking and financial sector as well. What are the other details that you're picking up from the TCS headquarters out there?
Yeah, a couple of things which I just wanted to highlight is that growth is coming in from BFSI sector, revival in North America, and retail. Outside of that, there's the margins have come at 25% as compared to 25.4% on a QOQ basis. So there's a marginal dip of margins which is coming in there. The revenue has been a surprise. It's up 4.1% on constant currency terms. And if you look at some other verticals, there have been a couple of verticals which have shown some improvement, especially BFSI in North America, because BFSI in Europe was doing quite well for them, but it was North American market which was sluggish, and that's the reason the turnaround is happening. So, Agam, the management is just coming in, so I would be we would be tuning into the management committee in just a while.
Okay, Sajid, we'll get more details, but for now, it seems, as you can see on your screens out there, we have the management who's coming through, and they will, of course, speak to the media at this point in time. I'm just going to recap the numbers in the meanwhile until we wait for Rajesh Gopinathan to come and tell us about how he says that the quarter has gone by. For now, we're looking at very strong operations from TCS, and as Rajesh Gopinathan will also talk about the earnings. He's just about to start, so listen in.
It's my distinct pleasure to share with you our results in the Q1 for FY19. But before I get into some of the details of the results, I want to take a bit of time to share with you the perspective with which we are approaching it. This quarter and the year has started off has been one of significant milestones and great momentum in many of the areas that we have been pushing strategically. From a momentum perspective, our thought leadership framework, the Business 4.0 framework that we have spoken extensively about in the past, is continuing to gain a lot of traction with our customers and is helping us power our growth, especially in areas like digital services. But even more importantly than digital services, this framework is an integrative framework which is allowing us to participate across growth and transformation agendas, cutting across the full spectrum of digital and core technologies. I think at the underlying heart of it is something that, again, we have spoken in the past about. It's our ability to invest in our own talent development, to broad base our talent, and to, most importantly, leverage the contextual knowledge that we possess and to deploy it at scale to drive growth and transformation for our key clients. I think the results are really a testimony of that, and are very, very encouraging as early signs of success of our strategic choices. The other key element of it is that we continue to lead the industry in the pioneering of newer industry-defining both technologies as well as strategies and work styles. I want to highlight two of them: our location-independent agile and our commitment to go 100% agile by 2020. I believe will be as transformative to this industry as GNDM was in the past century and past decade. And this location independent agile, we are by far the leading pioneers of it and the leading deployers of it, and very strong traction coming through on agile. The other element, which is relatively gaining traction now and relatively smaller but very encouraging signs, is our focus on what we call the machine first delivery model, which leverages automation in a very operational and actual value adding perspective. And again, that's an area that is gaining a lot of traction. We'll be sharing some more perspectives of it when we speak about Ignio, but great success that we are experiencing there. Finally, as I said, it's all about milestones also. This is the year that we are celebrating our 50th year of founding, and I want to thank all of you to be part of this celebration. It's also years that we are catching other milestones. In North America, we are now broken out into the top 60 brands in North America, rubbing shoulders across some very famous household names. So the continuing acknowledgement of the market to our brand and the brand value is something that is of great, gives us a lot of encouragement and drives us enthusiasm. So with that, let me get to the details of the quarter. As I said, it's been a great quarter to kick off the year with. We have been talking about increasing growth momentum for some time, and this is yet another quarter where we have been able to actually deliver on that. Our rupee revenue crossed 34,000 crores and growing at a constant currency terms 4.1% Q on Q, and on dollar terms 10% year on year. The growth has been driven from a service line perspective from digital, which now accounts for 25% of revenue and is growing at more than 40% year on year. If you look at the growth, one aspect of it is at 4.1% Q on Q. It is our fastest growth in the last 15 quarters. So again, underlying the increasing momentum that we are seeing. The other element of it is that from a segmental perspective, it is very broad based. We had shared with you last quarter that we are seeing some early signs of demand uptick coming from BFSI and especially the North American sector. And I'm glad to report that those early signs have been capitalized by us, and BFSI has grown at 3.7% on constant currency terms. I want to emphasize that this 3.7% does not include the BFSI revenue that is coming from our large platform wins. Including the large platform wins, BFSI is growing at more than 5% on a year-on-year, on a Q-on-Q basis. Similarly, North America is experiencing strong growth, again coming in at about 3.5%, and that sets us up nicely as we go into the quarter. From a profitability perspective, it has been again an encouraging year. We have successfully defended 25%, even though we have gone through with all promotions, salary hikes, and all the regular elements of it during this quarter. Even post all of that, we have been able to maintain profitability at the operating profit level at 25%. From a net profit perspective, again a big milestone year for us. We have crossed 7,000 crores in reported net profit and powered through that barrier at 7,300 crores. Our net profit growth on a year-on-year basis is now at 23% in reported currency, helped no doubt by a favorable currency environment. The growth has come with good cash conversion. Our cash to net profit continues to stay above 100, and in this quarter our cash conversion is staying at about 103%. After having distributed more than 6,500 crores as dividends in this quarter, we are glad to report that we still have cash and cash balances at about more than 47,000 crores, which sets us up nicely for the buyback that we have announced. Other key areas from a people perspective, our focus on organic talent development and our focus on investing in our people as the key element of our growth shows through in the most heartening way in our retention numbers. Our already industry-leading retention has actually ticked even better, with attrition coming down 10 basis points lower at 10.9%. Customer profile, customer metrics also continues to be strong. We have added 2 new customers in the 100 million plus range. And our bottom of the pyramid from a customer acquisition continues to be very healthy, setting us up nicely for sustained growth. Other elements, UK, we are seeing 18% growth, driven by some very large deals that we had spoken about in the past, both on the insurance space as well as in retail and CPG. Similarly, Europe continues to deliver significant growth, continuing its momentum as a growth driver for the company. From vertical industry space, while BFS and retail have taken the headline numbers, our smaller verticals like energy and resources continue to significantly outperform with growth about 30% year on year. So overall, I would say that it's a very encouraging quarter for us. It validates our early calls, both from a strategy perspective as well as our assessment of the demand environment and our ability to remain relevant to our customers across a wide theater of operations. So we are very enthused by what we see, and we think that it sets us up nicely to continue our growth momentum into the rest of the year. With that, thank you all, and we'll open it up for questions.
Thank you, Rajesh. So we'll start the first question with Kritika.
Congratulations on starting the year on a good note, gentlemen. Rajesh, my first question to you, of course, BFSI and North America. While you have seen the pickup this quarter, how sustainable is this? Is there chances of volatility around the corner likely to continue within this year itself for North America and BFSI?
I think the BFSI story is especially very broad-based. So what we're finding is that there's a wide spectrum of clients, and some of our most forward-looking and forward-thinking customers have increased significantly their investment into new projects, and they find a lot of relevance from us in our investments in digital and in various areas, whether it be analytics or areas like I spoke about on agile and automation. So our investments are resonating very strongly with our customers. The growth that we are seeing is very broad-based, which hopefully sets us up for a lot of confidence in terms of where it is going. Barring any one-off events, I think we are quite confident about where we see this growth.
So this is sustainable. Keeping that in mind, will FY19 be better than FY18? I know you hate answering that, but it looks like there are early signs of the year being better than the previous year.
As I said, we are focused on getting back solidly into double-digit growth trajectory. In constant currency terms, this quarter we are at 9.3%, and we hope to sustain that momentum. And it will take us wherever it will take us. But as a management team, we have shared that in the past. We are very focused on getting back well above the double-digit growth, I think, which is the biggest validation for us, or the biggest test on the appropriateness of our strategy.
Okay, and just very quickly, in terms of the kind of large deals that you're looking at right now, the visibility towards large deals, last quarter, by how much are the large deals that you won last quarter contributing in this particular quarter? And what's the order book like over there, especially for the digital large deals?
I think in terms of large deals that we announced over the last couple of quarters, last couple of quarters, all of them have started to contribute to the revenue. And as Rajesh explained in his opening remarks, BFSI really grew by about 3.7%. And then if you include the contribution from some of the large deals which are platform in nature, the BFSI actually grew by 5.6%, right? And as we speak, the pipeline of large deals is solid. We continue to stay focused in stitching together some of our digital offerings and enhance the largeness of the deal per se. And we are confident of securing some large deals in the future.
Okay, Ramki, what's the volume growth this quarter? And margins, you have a aspirational target, 26 to 28%. By the end of the year, would you be able to reach that?
Yeah, let me take on the, basically we talk of the as a business growth, because as the various types of the newer types of business which you are engaged in, the volume as such itself becomes a little bit of an irrelevant. So as Rajesh talked about, we had a constant currency growth of 4.1%. Now on the margins, if you look at the last quarter when we ended, we had a 25.4%. And this quarter we had, due to currency, we got about 70 basis points. So that should take us to 26.1. We also had about the salary increases, etc., which is about 180 basis points, which is the impact of the margins. So if you take from 26.1, if nothing else had changed, and if we factor in the increases for the salaries, we should have been at 26.1 minus 1.8. But whereas we closed at 25 because we were able to get back through operational efficiencies almost about 70 basis points. What it indicates is that typically we have the salary increases in the first quarter and we recover most of it during the next couple of quarters. We've been able to do that quite a bit in this quarter as well. So I think we are very much focused on what we have is our preferred range, and with including the large deals, and we have always maintained that with the growth picking up, we should be able to sustain that. And the growth has definitely picked up in this quarter as well. So that's where we see it on an holistic basis.
Okay.
Thank you, Kritika. I need to give others a chance. Thank you. Neha from ETNet. Sorry, BITV.
Good evening, gentlemen. Firstly, your commentary on your digital business. It currently contributes 25% to your revenue. Firstly, investments into digital, because you've identified it as a focus for the company going forward as a growth driver. Secondly, would like to get back to BFSI. You did ask us to wait for a couple of quarters to actually confidently call out your guidance for the complete year. So a commentary on that.
Let me take the BFSI one and then let NGS address the digital. On BFSI, as I said, we are quite enthused by the demand that we see. And we had called it early in terms of the green shoots that we spoke about. And they're developing nicely. Where we see the medium-term outlook continues to be positive. And we'll have to wait and see how that develops. As you know, we don't give guidance in terms of longer-term visibility. But the growth momentum that we see is definitely sustainable into the medium term. Jess, you want to?
Yeah. On the digital front, the growth has been very, very holistic. A lot of our digital offerings are gaining traction, and we have won deals of significance in each one of those offerings, whether it is TCS Interactive, whether it is cloud or IoT, or any of those blockchain. In each one of these segments, we have been able to win significant deals in this quarter. And this is a business that it's nicely set up, and the growth of 25% of contribution from digital, and quarter-on-quarter growth of upwards of 40%, means that look, we are very, very encouraged by what we have created as let's say industry-leading and differentiating offerings for each one of these segments. It's also important to note that look, some of these offerings are targeted beyond the CIOs, right? So the multi-stakeholder play with which we are going to market with, that seems to be also encouraging.
So since the digital revenue has constantly increased quarter on quarter, do you have any specific targets as to where you would want it to be by the end of FY19, considering it's a growth driver for the company?
No, at some stage it will be 100%. The way
But
we
no
see
targets.
it, right?
So also at the AGM, acquisitions was something that you said you are quite openly looking at. Any idea in terms of which categories acquisitions that you are basically scouting for? Any opportunities that you're currently looking at?
Yeah. See, we're always open for acquisitions. We're always looking at opportunities in products or area, as well as in areas where we don't have the competencies or offerings. And we are open for it, and we can keep evaluating it. Yeah.
Thank you. Thank you, Neha. It's Sajid from Bloomberg.
Hi, Sajid here from Bloomberg Quint. Rajesh, my first question is on the BFSI space. You said you spoke about it last quarter about how North America is going to come back. There's some green shoots. Can you give us some light on the kind of orders or contracts you're getting from BFSI space from North America, and how big are they, and what is the kind of work we are doing? I mean, is it going in the digital way, or it is traditional work which now getting opened up for many of the big financial companies there? Second, on the retail part of it, as retail is converging as well, it's also moving towards digital. Do you see strong tailwind for retail going forward from there?
See, the BFSI demand is coming across the board. So whether it be customer front-end facing applications, trying to reimagine the customer experience, a lot of activity happening on that. Combined with areas like wealth management, which is a big focus for customers. Wealth management is a classic one, which requires integration of all their offerings at the back end, but a very strong front-end customer experience part of it. Similarly, they're seeing the regulatory element of it continues to attract a lot of attention, and the use of automation to both drive efficiency as well as to lead to easier regulatory compliance is another big thrust area. We are seeing banks expand regionally. We're seeing Canadian banks come into North America and other banks trying to expand regionally. We see banks expand horizontally. One of our Nordic banks has very successfully spun off a peer-to-peer payment platform which we built, and we are now helping them take it to other customers. So banking is coming back in a very, very diverse set of opportunities, which we think will continue as this industry kind of resets itself to the new norm. On retail, at the heart of what we're seeing is the brick and mortar retail embracing digital technology to fight against the online only retailer. And many of them like Home Depot, Best Buy, even Marks and Spencer that we're working with, they're seeing very strong traction going after the pure online play by increasing the richness of their client experience and the richness of their offerings. We think that's a theme that will run through. Retail as an industry is still challenged. So, barring aside bankruptcies or such one-off events, the broad-based demand should continue.
Do you still see some kind of headwinds coming in from the North American markets, whether it's policy-driven or any other way?
Nothing to call out incrementally. We have been operating in a fairly demanding environment, and we have been operating successfully. I think our overall value proposition, both to our employees as well as to the market, is finding strong resonance, and that will continue to be. We are fully, compliant with the emerging policy environment, and we're quite confident that our strategies and our approach is in line with where the market is going.
Ramki,
Sajid, last question.
One more after that with NG as well. Ramki, I want to check with you on the EBITDA margins. This quarter, internal efficiencies of 70 bips helped you ensure that you touch the 25% mark. What is the key challenges which you see as you embark towards the guided 26 to 28% mark, which is there? And if you can also elaborate on the cross-currency, situation, this quarter you saw some tailwinds coming that helped you, and in fact, rupee depreciated by 5.3%. That also helped the top line and helped you in some way. But as you go ahead, what kind of hedges you have with respect to, the kind of the exposure you have? And this other one is the cash to profit ratio. It's more than 100%. Did you start your capex plan or expansion plans for some of the onshore areas in this quarter, or is it going to be done on the over the next few quarters?
Okay, I think you had quite a few questions all rolled into one, right? And I think the cross-currency factor, I think in the current quarter, the dollar against the rupee depreciated against the dollar, but was stable against the other currencies. But the cross-currency effect between these currencies and the dollar was quite pronounced. So from that perspective, while the dollar depreciation was almost 5%, what it translated into the final currency impact is around 2.7% or so. Second is hedging. We continue with our hedging program. We generally do it on a short to medium term, which is for rolling couple of quarters. We continue to be hedged on all the currencies which we have, the major currencies. So we don't change our program depending on where the currencies are moving. We stick to a disciplined program on that perspective. I missed your other two other questions.
Challenge you foresee as you move towards 26%?
I think we see the opportunities, because with the growth, with the digital growing at a significant good pace, and the larger deals, with many of the larger deals, and we are delivering to plan. So I think we only see the opportunities. We don't see anything significant to call out.
Okay. NG,
Sajid, I would give others a chance. I think you can ask the question to NGS.
Especially on the continental Europe, how's that looking? And BFSI was a strong area in continental Europe for you. Can you just elaborate on that, and the new deals which are coming in? When do they start kicking in revenues for you? Did any of them start doing in this quarter, or will it be in the subsequent quarters?
Continental Europe as well as UK, both of them have grown significantly. And I think both the 8 and 7%. So the overall business momentum there, the opportunities that we see in both Europe and UK across verticals have been terrific. Specifically with respect to BFSI, I think there are significant changes with respect to, let's say, whether the Payment Systems Directive 2 or IP banks wanting to adopt this ISO 20022 kind of standards. So the whole payments area, there are a lot of work that's happening there. So, and then in the previous quarters we talked about workplace transformation, workforce transformation, and then banks wanting to move to the wave 2 of the digital. I mean, all these things are becoming real, right? Becoming real, and we see significant opportunities in each one of them. And as we sign up these deals, I think there is a clear path to recognizing revenue as well as billing customers and collecting them, right?
Thank you. Pranay, from me.
Thank you. Congratulations on the 50 and also the $5 billion milestone quarterly. What I want to ask you first is, 4.1% growth in constant currency terms. That is better than what most of the street was expecting. But the divergence is such that 1.6% in dollar, 250 basis points, that's more than expectation, something that we would want to understand more from you. Is this something a little unanticipated? Because up till last month, everybody had penciled in maybe 250 basis point. So is this more than your own expectation, and do you think we've seen the maximum divergence between constant currency and reported dollar terms this time?
It's not a strategic call at all. So as you would see in this quarter, both Europe as well as UK clocked in at 18% growth. Okay. Obviously, when that gets translated into dollar on the way the currency is, it translates to whatever that dollar cross currency leverage is. As far as we are concerned, we are driving constant currency growth in every geography, and that is the strategy. What the print number is in whichever currency of choice doesn't really, that it's not something that we can call out, nor something that we plan for.
The only reason why I was asking is there isn't any doubt, given your start to the year on double-digit constant currency growth, But in dollar terms, we just want to understand whether we've seen the maximum divergence based on your internal experts, do you think?
No, internal expert will answer.
So I think on currency, all the pundits have always got it wrong. So it's I wouldn't want to venture so because it's very difficult to predict how currencies would move one against the other. Right? So as we said, we would look at on a constant currency basis, is there the movement and is it in the right direction, is it in the right momentum, right? And that is what we should be focused on. Now what happens from these currencies is a factor of certain external factors and we don't drive that specifically.
Okay. Also the margin performance is commendable. So just want to understand, since we are going to see better contribution from some of the large won deals earlier, the ramp up of which is most likely expected to show through the numbers in maybe second half of this year perhaps. Therefore, should this margin of 25% actually be the lowest for the year as of now? If we are going to see better contribution, better mix of deals and greater momentum in so many areas, then the margin should only get better from here?
See, I think we should look at it from the perspective of, I talked about, for instance, typically we have the impact of the salary increases and then we recover it over a period of time. We have been able to claw back quite a bit of it through the operational efficiencies. So to that extent, we have a little lesser challenge as we go through the year for recovery of that. The growth is definitely a factor as we target to get into the double-digit growth on the constant currency basis, and that growth itself will give that momentum. We have successfully started implementing many of the large programs, and so I think we only stay focused on our preferred range. We don't want to hazard and we don't provide specific guidance on whether it would be better than this, etc. But we are definitely confident and we should be staying focused on it and do whatever it needs to get to that and on a sustainable basis.
So lastly, when you say that the deal pipeline is robust, and just wanted to check with you with the kind of win rate or run rate that you're seeing as of now, what should one expect in terms of how better things are going to get for their conversion or the business basically to come in from the deals that you've been working so hard on?
We hope for good conversion. So, but as I said, I mean, it's we can't call out. The closure has been good. The deal pipeline continues to be strong, and overall the environment is quite positive, and we are executing on it. So I think we'll leave it at that, not stretch ourselves beyond that.
Okay.
Thanks.
Just last thing. Has the commentary on BFSI materially improved, or you're still taking it step by step and maybe a little watchful, although slightly more positive than last quarter?
Yeah, so it is materially improved to that extent. Last time we were talking about green shoots, now we are talking about visibility into the medium term. Definitely it's a material improvement from where we were last quarter.
Okay,
Thanks, Pranay. It's Varun Sudh from Mint.
Hi Rajesh, 3 questions. Firstly, on BFSI, if you can just help us understand, is it the insurance space? Is it the large banks? Is it the large banks in the US which are spending perhaps more? Is it the capital markets? Some clarity over there when you're saying things have turned for the better. That's the first one. I'll ask my other 2 questions once you've said.
So the big shift in terms of the momentum is coming from the banks. Not because we had spoken about insurance in the past, and capital markets is going on, but the swing, as it were, is coming from the banking space. I don't want to call out between geographies, but definitely in BFSI, it is the swing is coming from banking.
The large banks, sir, perhaps?
Large, mid, but yeah, we are mostly weighed on the larger of the spectrum. So it's coming from across the board.
Fair enough. Thank you, sir. So the second question on your digital growth, 44% growth, which is phenomenal. But over the last 2 years, 2.5 years, ever since you've called out your digital numbers, the growth has been pretty volatile, and it's understandable, early stages, but now almost a quarter of your business is growing at 44%, 25% digital business. If I have to ask you, say, going forward in the next 18 months, 24 months, do you expect there is enough and more demand in this digital to at least continue growing at whatever, double digits, so that it can offset the loss in the traditional business, thereby helping the company grow overall in the double-digit space?
I think that construct of thinking of it as digital offsetting loss in another business is not the way the industry is structured. The industry is going through a significant shift. So new investments are happening in newer technology stacks, and we are seeing significant investment in enterprises which are integrating digital into their core stack, right? So that is where the momentum is. What is more important is, are we participating in that momentum, and that's where this thing is. So thinking of it as two distinct things does not make sense. You have to think of it as a consolidated set, saying this is where the enterprise technology stack is. Within the enterprise technology stack, where is the growth coming from? What is the what are the characteristics of that growth, and are we well positioned for it? And the answer to that is that we are very strongly positioned, because it's not just front-end digital that is driving growth. It is about digital integrating very closely with the core. And going back to NGS's point, at some point in time, these distinctions will start blurring, because they will no longer be distinct sets. They will be much more integrated sets. So we will see 100% digital somewhere in the medium term.
Thank you. Just one last question, sir. For this year, at least for last year, cross-currency was more like a tailwind. For this year, can we expect it, or what's your commentary? Would it be a headwind or a tailwind? And I'm asking this question because when you are saying the management remains confident of a double-digit growth, is it the dollar, is it the constant currency?
No, last quarter also had specifically, I think you had yourself asked the question, and I had said that we are confident about getting in. We are focused on trying to get to double-digit constant currency growth, and that we expect to break into that sometime in the middle of the year. So this quarter we are coming at 9.3, and if the momentum continues, we should see that come through next quarter. So we as a management team are focused on constant currency. The reported dollar was 11.7 last quarter. It is 10% this year. We practically have zero control over it. If I see growth in Europe and UK, I'm not going to leave it because it has got a cross-currency impact.
So would cross-currency be a headwind or a tailwind, sir? Thank you.
As Rajesh said, the movements in these currencies one can never predict. So one can't hazard a guess whether it will be a headwind or a tailwind. What is important is to stay focused on, is your business growing? And that is measured by your constant currency growth. If I had done business of $100 with somebody, has that 100 gone to 102, 103, 105 is what is important, right? Or in any other currency. So how it gets translated is something which we manage the currency risk through our hedging programs, etc., for our translation. But cross-currency, etc., is something which nobody can actually predict, and we don't factor it into our business planning. We stay focused on what is our overall business growth, and that is really translated into a constant currency growth. That is what it is important.
But a better way of thinking about it would be that North America was growing slower last year, whereas we expect North America growth to pick up this year. That's the more important element of the dollar story. What happens as to how does the European number gets translated into a reported dollar is not I think the big shift that we are seeing is the increasing momentum in North America.
Thank you, Varun. It's Romita from Business Standard.
Hi. So one thing I'd like to understand in terms of your digital deals would be if it's possible to give a kind of breakup of, since you have a lot of digital offerings, what is it within digital which is particularly driving traction? That would be one. And also, have you reached a point where your digital roles are similar to where the kind of roles you have commanded in your legacy projects, in the large consultative roles? That would be for you. And for Ajoy, I would also like to ask, in terms of hiring in your other locations, I know you don't give geographic breakups, but just to understand, is there, has the hiring in other regions also picked up, and does it also have any impact at all on the margins?
Okay, take the first one and then Ajay. So think about our digital stack in three ways. We are not breaking it up at a revenue level, but we're giving a lot of color in our fact sheet. So you will find 2 slides in there, which gives you both commentary about the individual services as well as some of the deals spread out by various areas. But there are 3 big stacks inside digital. One is what we call the digital core, which is the transformation of enterprise technology stack to make it digital ready. So that's a big area. Cloud and other elements come inside the digital core. The second layer is what we call the intelligence layer, where both automation and analytics have a big role to play. And the third layer is what we call the experience layer, where the interactive is a big component of what we say. So you will find in our fact sheet commentary about our participation in deals across all of this, as well as in various other elements. Areas like IoT cut across all of it. They have elements of all of it. So you will find a much more granular commentary in the fact sheet. Currently, we are not breaking out the revenue numbers by the individual lines. Talk about the...
Yeah, as far as, before I start, I think we talked about milestones. I should also point out that we have crossed 400,000, 4 lakh employees. So that's again another milestone. And as far as the quarter has been concerned, Rajesh pointed out that we did do all our increments, we did do our promotions and all that. So as a result, it's been a fantastic quarter. And from our employees' point of view, and I think from a variable compensation that we have, that also we have announced, it's been about 100%. So I think from all angles, it's been good. Coming to your specific question on the hiring side, if you look at Q1, especially last year Q1, we were negative from a headcount point of view, whereas this year it has been 5,800 positive. So it's been good, significant hiring, and because we are seeing growth, we are seeing the kind of demand that the business has, and it's been all sorts of both in terms of entry level as well as laterals across the globe. So hiring is up in most of the geographies that we are operating in. And the other part is some of these large deals, they also come up with insourcing element where we take in employees from other organizations into TCS. They become TCS employees, right? And that is a significant effort because that's again an integration piece that comes in, onboarding the employees and then getting them integrated into the existing culture of TCS. So that's what has been the focus and that's what has been happening. So in a nutshell, yes, hiring we have been doing across the globe. It's been a good amount of hiring. See, margin is a different aspect. That is, you hire people, you have to be competitive in the globe wherever you are going for the talent. And then you have to manage the margin based on your efficiency, based on your optimization, the tools, automation, and everything else. And that's what we do.
Thank you, Amita. It's Anurag from Z.
Sir, just want to understand how big would be this Ayushman Bharat health insurance project for the company, IT infrastructure? Is there any other projects also you are working with government on domestic front?
It's very difficult for me to size it, but let me share with you that in the state of Andhra Pradesh, our similar project has been the template that the government studied a lot in terms of thinking about it. It's called the Arogyashri project. So we have a lot of experience in this space. We have contributed our thinking and our consulting to help them think through their plan. But exactly how that plays out and what our participation in it is difficult to say. But we are very, very strongly positioned. We are by far the largest executors of nationwide mission critical programs in this country. There is nobody who has the track record of the kind of work that we have done. So we are well positioned for it, but as the specifics emerge, we will see.
So if you could tell what all will come under your domain, if possible.
Our participation is typically across the board. We do consulting, we do design, we do implementation, we do post-implementation support. So we have both the track record and the appetite to participate across the board. You've seen that in our Passport Seva project. You've seen that in the work that we have done for the payments, the BEAM UPI project. So we have, as I said, both the track record as well as the appetite to participate across the stack.
Thank you, Anurag. It's the last question from Ken from Nikkei.
Hi, nice to meet you. My name is Ken Koyanagi with Nikkei Asian Review. I was newly posted in Mumbai this April, so Pleased to see you. Anyway, please help me understand why there is a huge difference between so-called new technology revenues at Accenture and your digital revenue. Isn't it an apple-to-apple comparison, or is it just a matter of classification of revenues, or is there any fundamental differences in the way you do businesses between you and your competitor? And if there is, what kind of measures do you have to do?
I don't have a direct answer to that. I think broadly they are similar. Broadly you will find us participating a lot on the full digital stack, that what I explained to the earlier question. So it's currently running at a run rate of slightly more than $5 billion, growing. Last year it grew at 30% plus. This quarter we are starting off with a 45% growth. I think the most important difference from some of the other competitors is that our revenues have been built entirely organically. We do not have a active inorganic strategy or an active inorganic component in the way this revenue stream has grown. So the $5 billion of revenue have all been built organically, both the business as well as the delivery side, the talent development side. I think that by far is the biggest difference. And the other big element of it is that we think of it as again I had mentioned it earlier, we think of it as an integrated set. So while we report it differently, our biggest sweet spot is in the interface of digital and existing technologies. We call it the focus on the digital core. So our big focus is on that interface and helping enterprises leverage digital technologies within the context of their existing stack and helping them transform. In those two elements, in the focus on organic growth and in the focus on the core digital core engineering part, I think we are by far the best in the world and far ahead of competition.
Could you elaborate a little bit? What is the difference between organic and non-organic revenues?
The differences, as I said, both from a talent acquisition side as well as business development side, we have not acquired companies to grow into the digital space. We have actually both delivery side, sales side, solution design side, all of these elements have been built in-house. And by leveraging what we call the contextual knowledge that we have of the customer and marrying that with the new technology knowledge, we've been able to grow this business. And there we are by far unique in the industry.
Are you going to continue to do that?
Absolutely. It's a stated strategy. It's a strategy that had been, I think, met with a bit of skepticism in the past by the market. But our success in the recent times is a great validation of our strategic focus and our ability to execute on that strategy.
Thank you, Ken. And thank you, everyone, for joining us. You can join us for a cup of tea at the foyer and can ask the television crews.
Okay, so that's the management of Tata Consultancy Services talking to us about a quarter gone by, which has actually been, well, surprising and positively surprising, considering it's been a beat on its top line, bottom line, as well as margins front, especially the margins which stand around 25% as against expectations of 24.4%. And of course, the big top line beat standing at around 6.8% growth sequentially is, well, a lot of that is on account of the strength coming through finally after several quarters in the banking and financial vertical. And that's the reason why we are looking at that big beat when it comes to its top line. However, in constant currency terms, perhaps in dollar terms, it's been largely in line. And as the CFO of the company has suggested that while they have seen a depreciation of the rupee against the dollar has in its equation with other currencies remained largely stable. But you know, that hasn't really stopped the company from posting that 25% EBIT margins, despite the fact that they did have this wage hike come through, the seasonal effect for the entire industry. We're going to have to wait and watch for more on the rest of the companies. Do remember that Infosys, of course, comes up with earnings this coming Friday. But for now, TCS earnings looking good, beat on all fronts. And well, let's just wait and watch. Perhaps we could expect a positive opening going to today's job trade. And with that, it's a wrap on the special edition of Tata Consultancy Services earnings. But lots more lined up, so stay tuned at the Bloomberg Quint.